Good morning. This is Melissa Napier from Conagra Brands. Thank you for listening to these prepared remarks on our fiscal 2024 third quarter earnings. At 9:30 Eastern Time this morning, we will hold a separate live question and answer session on today's results, which you can access via webcast on our investor relations website. Our press release, presentation materials, and a transcript of these prepared remarks are also available there. I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We will be making some forward-looking statements today, and while we are making those statements in good faith based on current information, we do not have any guarantee about the results we will achieve. Descriptions of our risk factors are included in our filings with the SEC. We will also be discussing some non-GAAP financial measures. Please see the earnings release and the slides for GAAP to non-GAAP reconciliations and information on our comparability items, which can be found in the investor relations section of our website. I'll now turn the call over to Sean.
Thanks, Melissa. Good morning, everyone. Thank you for joining our third quarter fiscal 24 earnings call. Our Q3 results demonstrate steady progress and the continuation of the momentum we've been building throughout the course of the fiscal year. This starts with our top-line performance, which again saw sequential improvement driven by our brand-building investments in key areas. Our brands continued to perform well in the broader market, including strong unit share gains across our portfolio, particularly in the large frozen single-serve meals category. Importantly, outstanding progress on delivering cost savings helped fuel these investments, enabling us to simultaneously improve volumes and sustain margin recovery. In addition to our solid margin performance, our strong free cash flow drove further reduction in our net leverage ratio as we continue to prioritize debt reduction. As we enter the fourth quarter, our financial results and strategic initiatives further support our confidence in our ability to achieve our targets and drive value for shareholders. Based on the consumer response to our investments, our progress on cost savings, and year-to-date performance, we are increasing our expectations for adjusted operating margin while reaffirming our net sales and adjusted EPS guidance. Turning to slide 5, our Q3 results were largely in line with expectations. As we just discussed, we saw sequential volume recovery. We're supporting our brands with high-quality merchandising and advertising. Importantly, as we have made these investments, we've been able to sustain our gross margin. We also continue to deliver substantial improvements in free cash flow over the first 3 quarters of fiscal 24, with an outstanding conversion rate of approximately 124%, further bolstered by year-to-date cost savings of 4%, which I'll dig into in a moment. Slide 6 shows our Q3 results. Net sales were approximately $3 billion, reflecting an organic net sales decline of 2%. Adjusted gross margin increased 52 basis points to 28.7%, driven by increased productivity. Adjusted operating margin was 16.4%, representing a 49 basis point decrease over the prior year quarter. Q3 adjusted EPS was 69 cents, which decreased 7 cents over the prior year quarter, largely due to our increased investments in A&P and SG&A, which we'll touch on later. As you can see on slide 7, stabilization in our supply chain has resulted in stabilization within our manufacturing structure, from an improved flow of raw materials to a more experienced workforce to getting goods out the door more quickly. This stabilization has enabled us to further drive our productivity initiatives. On a year-to-date basis, we've delivered significant improvement across key supply chain metrics from fiscal 2023. Our service levels reached 96%. We've reduced our inventory dollars by 7.1% over the prior year quarter. And as I noted a moment ago, cost savings reached 4% year to date. That includes cost savings of 4.6% in Q3. While these numbers may fluctuate slightly from quarter to quarter, The improvement in trend is undeniable and a credit to our dedicated employees. Productivity is critical to supporting investments across our business, and strong productivity performance unlocks our ability to invest in our brands while maintaining margins. As we discussed at CAGNY and earlier today, we maintain a multifaceted and disciplined investment program, as shown here on slide 8. We are continuing our robust brand-building investments across merchandising, innovation, and advertising to drive volumes while sustaining the gross margin recovery we have worked hard to achieve over the past couple of years. So we continue to see good ROI from these investments. Consumers are responding to our merchandising and advertising as our brands are standing out both inside and outside of stores. We also continue to prioritize investment in innovation, which remains the most important tool in our strategic playbook and the key to strengthening our brands while driving sustainable long-term growth. This year's innovation slate has been met with some of the strongest customer enthusiasm we've seen yet. On slide 9, you can see the cadence of our volume recovery. Importantly, this is not a new phenomenon, but a continuation and acceleration of the progress that began 2 quarters ago. Additionally, trends in consumption across our key domains, as seen here on slide 10, reinforce our confidence in even further volume recovery. Again, a continuation and acceleration of the progress we've seen through the course of the year. And encouragingly, that momentum has continued in Q4, driven by frozen, where our most recent 4 weeks of volume consumption improved to minus 1.2% versus year ago. That's around a 6.5 percentage point improvement since Q1. I also want to point out that Conagra's portfolio has proven to be especially resilient when compared to the broader market. On slide 11, you'll see approximately 52% of our brands are holding or gaining unit share, a 12-point increase compared to the prior year period. And our share performance is even stronger within our strategic frozen and snacks domains. Importantly, approximately 59% of our brands in those 2 domains held or gained unit share, which compares favorably relative to the performance of our peers in their strategic domains. This strong share performance has been fueled by the solid lifts we've generated through high-quality merchandising investments, as shown here on slide 12. We have demonstrated growth across the entire portfolio when compared to prior year levels, particularly in our frozen domain, where we have focused our investments. When looking at frozen specifically on slide 13, we are outperforming the market on a volume basis amidst what's been a challenging volume environment overall. We realized a 1-point unit share gain in the total category, with single-serve meals, sides, and desserts driving the increase, and strong performance from some of our biggest and most strategic brands like Healthy Choice, Banquet, P.F. Chang's Home Menu, and Marie Callender's. Taking a closer look at single-serve meals on slide 14, you can see the extent to which our strategic investments in enhanced merchandising across this category enabled us to deliver record share performance. Slide 15 highlights some exciting innovation we have planned through 2024. Starting with our single-serve meals, we are innovating across the portfolio to cater to a greater variety of consumer preferences by elevating and modernizing our recipes. For larger groups, we are expanding our multi-serve meal portfolio with the addition of frozen products that offer incredible value to consumers, both in terms of quality and price. We're also moving our Dolly Parton line into frozen, offering both baked goods and frozen meals. And finally, in vegetables, we are expanding our Bird's Eye brand with exceptional culinary-inspired products that appeal to younger, more affluent households. Slide 16 details our international and food service segment performance. In our international segment, volume and net sales increased over the prior year quarter, driven by strong performance in our Mexico and global export businesses. This carried forward the momentum we've built thus far in fiscal 2024, as organic net sales have increased 4.8% year to date. Net sales in our Foodservice segment decreased in the quarter, largely due to our decisions to reduce or exit less profitable business in lower priority categories, as well as some softness in food away from home traffic. Despite this year-over-year decrease, we've seen a 2.9% improvement in organic net sales year to date. We continue to deliver very strong free cash flow, which has enabled us to improve our net leverage ratio. Dave will cover this in more detail shortly, but as you can see on slide 17, we drove a meaningful improvement in free cash flow and concluded the quarter with $1.2 billion of free cash flow year to date. Our efforts to prioritize debt reduction continue to yield strong results, and in Q3, we reduced our net leverage ratio to 3.44 times. Our fiscal 2024 guidance across key metrics remains largely unchanged. However, we are updating our adjusted operating margin guidance to reflect our ability to drive value by balancing our investments in our brands with cost savings. Overall, we are pleased with our performance during the quarter, which reinforces our confidence in our brands, plans, people, and agility. With that, I'll pass the call over to Dave to cover the financials in more detail.
Thanks, Sean, and good morning, everyone. Slide 20 highlights our results from the quarter, which demonstrate our steady progress on top-line recovery while maintaining our margins. Q3 marked the fourth consecutive quarter where we've reported an improvement in the rate of volume change over the prior year's quarter. Q3 net sales were $3 billion, reflecting a 1.7% decrease from the prior year quarter and an organic net sales decline of 2%. We made strategic investments to support volume recovery while delivering solid margin performance during the third quarter. Q3 adjusted gross margin was 28.7%, an increase of 52 basis points versus prior year, and an improvement from first half adjusted gross margin of 27.2%. Adjusted SG&A increased 7.4%, primarily driven by the timing of incentive compensation expense. A&P also increased 6.5% and was 2.8% of net sales, reflecting our increased advertising investment on the Birds Eye and Healthy Choice brands. Adjusted EBITDA decreased 5.3%, driven by lower operating profit and a reduction in equity method investment earnings as our Ardent Mills joint venture wrapped on record earnings in the prior year. We delivered Q3 adjusted net income of $329 million, or 69 cents per diluted share. Slide 21 provides a breakdown of our net sales for Q3. The 2% decrease in organic net sales was primarily driven by a 1.8% decrease in volume, given the lower but improving consumption trends, as well as a 0.2% negative impact from price mix, largely driven by the company's investments in the quarter. While our investments are up in the quarter as we planned, total merchandise consumption is in line with pre-COVID levels. We also saw a small benefit of 0.3% from favorable impact of foreign exchange. Slide 22 outlines the top-line performance for each segment in Q3. As Sean detailed, we drove volume recovery across our domestic retail business during Q3 versus last quarter. Our grocery and snacks segment increased net sales 3.4% in the quarter versus prior year, driven by improved price mix. Net sales declined 8.1% in our refrigerated and frozen segment, due mostly to an increase in strategic investments in our frozen business. While these investments contributed to a decline in price mix of 4.8% in the quarter, they supported dollar share gains, most notably in our frozen single-serve meals category. We are confident that our continued merchandising investment and innovation will help our domestic retail volumes continue to improve moving forward. Our international segment's performance was primarily driven by another strong quarter from the company's Mexico and global exports business. Our Foodservice segment was impacted by year-over-year volume declines that were partially offset by price mix increases. Turning to our Q3 adjusted operating margin bridge on slide 23, we continue to focus on driving operational efficiency and cost savings to improve our margins. In Q3, our efforts drove a 52 basis point increase in adjusted gross margin from prior year. We delivered a 3.3 percentage point margin increase in supply chain productivity, which represents approximately 4.6% of cost of goods sold for Q3. This was offset by a 1% impact from absorption. We also realized a one-time benefit related to insurance proceeds from prior year lost sales from our canned meat recall within our grocery and snack segment, and a smaller one-time benefit in our international segment. We are very pleased with the continued improvement in our supply chain, as Sean discussed, enabling us to increase investment while improving our gross margins. Slide 24 details our adjusted operating margin performance by segment for Q3. Our grocery and snacks, Foodservice, and international segments all delivered double-digit adjusted operating profit growth and significant adjusted operating margin improvement in Q3, driven by the cost savings and productivity improvement just discussed. Our Refrigerated and Frozen segment operating margin was 16.9% for Q3, which was 30 basis points above the Q2 margin. However, Refrigerated and Frozen operating margin was below prior year by 385 basis points, due primarily to higher prior year's gross margin, which benefited from the timing of inflation-driven pricing, and secondarily, to increased merchandising and A&P investment in the current year quarter. As Sean highlighted, we see this investment driving strong lifts, and we will continue to invest in a disciplined manner moving forward. Overall, the efficiency of our operations in Q3 resulted in cost savings that enabled us to fund investment while maintaining gross margin. That is a formula we want to continue going forward. Q3 adjusted EPS was 69 cents, which decreased 7 cents over the prior year quarter. EPS was impacted by lower net sales in Q3, but offset due to our strong cost savings performance. The entire amount of the adjusted EPS decline in Q3 was driven by the increase in adjusted SG&A and A&P investment, a slightly higher tax rate versus a year ago, and lower equity method investment earnings from Ardent Mills. Slide 26 displays our continued progress on free cash flow and our net leverage ratio. For year-to-date Q3, we delivered a $786 million improvement in free cash flow over the first 3 quarters of fiscal 23, which represents a free cash flow conversion rate of approximately 124%. Our focus on managing inventory levels and improvement in accounts payable, combined with our improved cash returns from our Ardent Mills joint venture, contributed to these strong results. Not only is our free cash flow conversion the highest it's been in recent history, our free cash flow yield is the top among our peer group over the last 12 months. We continue to prioritize debt reduction, and our strong free cash flow enabled us to reduce debt more than $700 million over the last 12 months and by approximately $400 million since the last quarter. This resulted in a lower net leverage ratio of 3.44 times at the end of Q3, and we now expect our year-end net leverage ratio to remain at this level, which is an improvement versus our estimate last quarter. Slide 27 updates our full-year fiscal 24 guidance assumptions. Given the productivity progress we detailed today, we have modestly increased our adjusted operating margin expectations to approximately 15.8% for the full year. Our guidance ranges for organic net sales and adjusted EPS remain unchanged. We expect to finish the year towards the lower end of our organic net sales range and towards the midpoint of our adjusted EPS range. We are also adjusting expectations for CapEx and interest expense, which we now anticipate at $425 and and $435 million, respectively. That concludes our prepared remarks. Thank you for your interest in Conagra Brands.
Good day and welcome to the Conagra Brands third quarter fiscal year 2024 earnings conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on a touch-tone phone. To withdraw your question, please press star, then 2. Please note, this event is being recorded. I would now like to turn the conference over to Melissa Napier, SVP Investor Relations. Please go ahead.
Good morning. Thank you for joining us today for our live question and answer session on today's results. Once again, I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We may be making some forward-looking statements and discussing non-GAAP financial measures during this session. Please see our earnings release, prepared remarks, presentation materials, and filings with the SEC, which can all be found in the Investor Relations section of our website, for more information, including descriptions of our risk factors, GAAP to non-GAAP reconciliations, and information on our comparability items. Operator, please introduce the first question.
The first question today comes from Andrew Lazar with Barclays. Please go ahead.
Great. Thanks so much. Good morning, everybody.
Good morning.
Sean, morning. I guess, Sean, based on scanner data, most expected, I think, some upside in grocery and snacks and maybe a bit more weakness in refrigerated and frozen. This dynamic was certainly more extreme, I think, in the quarter than I think many had modeled. So I guess in grocery and snacks, Conagra had about a 4% benefit from price mix, and that was, well ahead of what we'd thought. So curious kind of what drove that. And then in refrigerated and frozen, you talk about success in single-serve meals, but trying to, corroborate how we sort of marry that with the 8% organic sales decline in that segment. And maybe that's more of a function of refrigerated, versus frozen in some way. So those two aspects would be really helpful.
Yeah, let me unpack all of that for you, Andrew. As I said in the prepared remarks, things unfolded very much in line with what we expected. And as you heard us say, our investments in frozen have driven a nearly 7-point swing in our scanner volume from Q1 to the most recent 4 weeks, where volume came in down a fairly modest 1.2%. So very strong progress in frozen overall, which is important because that's been the focus of our investment. What you're seeing, and the reason for the optics being a bit confusing, is the reason the R&F segment in total numbers don't show the same magnitude of inflection is noise in the refrigerated part of the business, which was, by the way, also consistent with what we anticipated. Recall, our refrigerated businesses are predominantly pass-through categories, and one of the rare areas in our portfolio where we've actually experienced deflation and rolled back prices accordingly, as pass-through categories do. And while, that creates some short-term volatility in dollars until it's in the base, as deflation passes through, importantly, margins are preserved due to the lower COGS. The other dynamic that I'll point out there in R&F is, in addition to that piece, our table spreads business benefited in Q3 a year ago due to a large competitor having a particularly weak quarter due to supply chain challenges. So that's kind of some color on R&F and why the divergence between frozen and refrigerated. With respect to grocery and snacks segment, we also expected a solid quarter in the G&S segment, and we got it. And there were several factors there, from pricing in tomatoes to bounce back in canned meat like chili, Vienna sausage, where you'll remember we had a recall in the year-ago period, but also strong innovation like our new Wendy's chili, where we've grown significant market share. So overall, our grocery brands are great consumer options for people who are seeking to make convenient meals at a great value. It's also a good mix for us. But I think the big picture is one of the benefits of a scale diversified portfolio is that, as they say, there are horses for courses. So you're inherently hedged when the macro environment is less stable than normal. Big picture for us, I like the volume momentum we saw in Q3. I like what I've seen so far in Q4, and I expect further progress from here.
Got it. And then I guess just lastly, it's obviously volumes in the quarter were still down, but a sequential improvement, and that's obviously with the expected step up in investment spend. So I guess you kind of talked to this a little bit, but how would you characterize like the current volume momentum, and would you expect volume trends to inflect positively, by the time we get to the start of FY25, or are dynamics still such in the broader industry that that's a little bit hard to peg right now? Thank you.
Well, it's one of the reasons why we're looking at this so closely. It's one of the reasons why I referenced the most recent 4-week scanner data and frozen being down a mere 1.2. We obviously are seeing and expect to continue to see further progress. We're not going to draw the line in the sand and say, this is the month, this is the day where it's going to cross over. Next quarter, obviously, when we give 25 guidance and have our annual operating plans fully rolled up, we'll give you that color. But it's moving in the right direction. That's the bottom line. I mean, this is a food thing. Everybody wants to see volumes go in the right direction. I think companies and investors are, willing to see investment in order to do that. But what I think people want to see overall is, can you hold your gross margins while you're making those investments and getting the volume results that you want to see? And that's what was particularly encouraging to me in the quarter is we made the investments we intended to make. We got the volume improvements that we wanted to see. We've got continued volume progress into Q4, and we've done all this while maintaining, even expanding gross margins that we worked very hard to kind of claw back after the initial compression from all the huge inflation we experienced a couple of years ago. So, that I think is a positive, and I think it foreshadows just continued momentum from here.
Thank you.
The next question comes from Ken Goldman with JP Morgan. Please go ahead.
Hi, thanks, and good morning. Just wanted to ask a quick question about 4Q. Your implied guidance might suggest around -2% in organic sales growth. It's pretty similar to what you posted in 3Q. Some might say it's a little prudent, though, just given you do have an easier comparison both on 1, 2, 3, and 4-year basis, just looking that through. You have the lapping of the Americold issue. So I'm just curious if it's right to think that's a little bit prudent, or are there maybe some offsets to that, maybe a little bit of less of a help from mix, perhaps, just throwing that out there. Just trying to get a bit of color on those building blocks as you think about that.
Ken, I'll make just a quick overall comment and flip it to Dave. But, after the last 9 months of kind of elongated volume recovery, our posture has been one of let's lean toward prudent because, the macro environment's been more volatile than I think anybody expected. And so that's been our posture. That's why we didn't bake in anything heroic in our back half plans. And I think that'll continue to be our posture until we see a macro that is just inherently bouncier than it's been. But it's going in the right direction, and that's good. And I think we're in the. I like the way we're set up for Q4. Dave, you want to make any additional comments on Ken's point?
No, I think you pretty much hit it. I mean, Ken, we're expecting sequential volume improvement, and we've been talking about that, and we've seen it through Q3. But we also expect to continue investing. So obviously, both of those things impact the top line. And you referenced mix. We do have mix impacts in this portfolio, and they can be, slightly positive or slightly negative any quarter. So, as Sean mentioned, we want to be prudent, but, they're the 3 key drivers that get us to towards the low end of the sales guidance range for the year.
Yeah, and just to also to think about it this way too, Ken, is, our fiscal ends in May, which is kind of an odd month, but, what's happening for us in May is our new innovation is rolling into the marketplace. We are focused at that point of the year always on the next fiscal year and how do we build momentum in the next fiscal and big events like 4th of July, back to school. And so, we're really getting so late in the year now that a lot of our attention is focused on getting these annual operating plans finalized and trying to set up next year to be as strong as possible, including around, key dates and holidays and things like that.
And then while we're while we're talking about next year, and thank you for that, I realize it's too soon to provide any kind of quantitative numbers. I wouldn't ask for them, or quantitative information, rather. But at CAGNY, you said you're doing what you can to be as close as possible to be on algo. And I was just curious, where your level of confidence on that topic stood today, how you're thinking about maybe balancing what might continue to be a challenging consumer environment, I guess, with maybe what also could be some friendly top-line comparisons, progress on cost savings, cash flow, and so forth. Just trying to think directionally how you guys are thinking about that now.
Well, you're 100% right. We will give you our complete and total view of fiscal 25 on our next call. I think for this call, the key messages to our investors are we are getting momentum on the volume line. We are moving kind of toward that Mendoza line here that everybody wants to see us cross over at some point. Exactly when that happens, as you've heard from other companies, I think you'll get more perspective on that in the coming months as people finalize their plans. That'll be true of us. But, make no mistake about it, we've been watching the consumer for their readiness to kind of reestablish, their typical behaviors. And we've said we're willing to kind of nudge them along if we see that readiness. And so we've been methodical in not only monitoring their readiness, but putting the investment out there to nudge them and measuring the response very carefully. And we're getting a good response. We're getting close. It's not as if the momentum is slowing. If anything, it accelerated in the last quarter. So I think all I can say at this point is I like the setup. We just have to continue to do more of what we've been doing, continue to drive it, which is that mindset of volume is important, but so is protecting margin. And that's, one of the things in our materials today that you saw is why our supply chain team is so important. That work we've got going on in supply chain to really maximize cost savings provides critical fuel for growth. And we expect that to continue. And that's how, ultimately over the long haul, that's how we're going to drive volumes back positive again. We got a really tremendous stuff going on in supply chain with cost savings right now. And as you saw in our Chief Supply Chain Officer, L.A. Ebely's presentation at CAGNY, we are on track to implement our connected shop floor program in half our facilities in the next couple of years. And that is outstanding performance overall. If you look across the industry, that's a leading position in the industry, and that will be key to margin expansion going forward. And so we're very excited about that work and the legs that it still has in front of us.
The next question comes from David Palmer with Evercore. Please go ahead.
Morning, guys. Question on frozen. I'm curious, particularly on frozen entrees. What's your thought there about a return to growth in sales in that business, and if there's any sort of juxtaposition that you would make between frozen entrees and frozen vegetables, and how you view the challenges and opportunities for each in returning to growth. Thanks.
Sure. David, you saw in the presentation today that in Q3 of 24, our frozen single-serve meal business achieved over a 51% market share, which is up 1.7 points versus a year ago. And if you remember Tom McGough's comments from CAGNY, we've become the leading frozen food producer in the United States, largely because of the success we've had in frozen single-serve meals over the last 5 years. So our performance there continues to be stellar, and we continue to gain share. And by the way, I've made the comment many times that we under-index as a company in terms of competing with private label. Nowhere is that truer than in frozen single-serve meals. So, for example, the entire size of private label in frozen single-serve meals is 1.8 points. Our business is 51.2 points of market share. And in fact, our growth in unit market share in the last quarter was 1.7 points, which is almost the total equivalent private label. So we like our position, our market in the market structure there. We like our brands, and we feel great about it. And it's been a growth juggernaut for us for the last 5 years, and I see no reason why that won't continue. In terms of Birds Eye and vegetables is one of the categories where earlier in the year we saw consumers exhibit value-seeking behaviors. So, for example, we saw some trade down from fresh to frozen vegetables to canned vegetables, despite the obvious quality trade-offs. But Birds Eye is also one of the businesses that we are investing against with a clear focus on the superior relative value of frozen vegetables versus other choices. In fact, the advertising we're running now is directly comparative, as I mentioned to you previously, and features the clear benefit of our Stay Fresh flash freezing process, which basically freezes time for the consumer and keeps our vegetables at the peak of freshness until the consumer's ready. So it's a clear advantage, and in the most recent 4 weeks of scanner data, Birds Eye grew overall share, even though our focus is really on the value-added tier. So we've got investments there, we've got momentum there, and it's an important brand, and you're not going to see us slow down on the marketing support and the innovation front.
You know, I just wanted to follow up on Ken's question. Maybe one way to ask what ways are you going to be really reviewing your business in the coming months as you contemplate how you're going to be guiding fiscal 25? Is it simply just, volumes getting closer to flat overall in the business, or are there any areas of the business you would be particularly focused on that will really help you think about how you guide for 25? Thanks.
Well, I think the way I think about it principally, David, is we are an ROI-minded management team. We are not bashful about putting investments out there to support our brands if they drive the impact that we want to see in the marketplace, which in turn drives the return on investment. So where we are in our typical annual operating planning process is, brand by brand, looking at the market fundamentals on what's happening within the brand dynamics, the competitive dynamics of the category. What do we know about the need for those consumers in those categories to have some kind of stimulus to kind of nudge them back to their normal behaviors, and what kind of lifts can we expect? So we do that on a brand-by-brand basis, and that ultimately leads to our investment profile. So we're in the midst of that right now. We've obviously run a lot of what you might consider to be test markets starting in Q2 in terms of those investments and understanding what those ROIs are, and we're racking it up right now. But I think what's encouraging is we are seeing responsiveness, and we are seeing good ROI, and I think that bodes well going forward.
Thank you.
The next question comes from Chris Carey with Wells Fargo. Please go ahead.
Hi, good morning. One thing that did stand out was that the inflation impact to margins did get a little bit worse quarter to quarter. Can you just expand on that, if that's driven by commodities, non-commodities? I think you mentioned tomatoes with respect to some incremental pricing. Just any context on what is driving that and if there are any nuances.
Yeah, I'll make a quick comment, Chris, and flip it to Dave. Obviously, inflation has slowed, but we're still in an overall inflationary environment, and some things more recently have inflated, and that has led to taking some price. So you get the benefit of that, but it also, there's a lag effect. So we've kind of taken you all through the mechanics of how that works, and that's part of it, right? Is when you get new inflation, you take new pricing, you got a bit of a lag effect, so you get a little bit of margin pressure in the early days while you're waiting for that to get reflected, and then you see a pretty rapid inflection from that point on. So that may be a piece of it. Dave, you want to add more color?
Yeah, just a little color. So, Chris, our inflation rate as a percentage of cost of goods sold for the quarter was 2.9%, which drove the 1.9% margin impact that you see in the materials. So we're still on track we said full year approximately 3%. We're still on track for that, maybe a tick above that. But, the inflationary areas, you mentioned tomatoes. We've talked about that. We've taken pricing. That was a big driver of the price mix in grocery and snacks for the quarter. We've also seen inflation more broadly in vegetables, in different ingredients and sweeteners, starches. We have some inflationary areas. These things ebb and flow. We've talked about this in the past, we still have inflation in our manufacturing operations, both with our labor and overhead, and transportation, is relatively flat, a little bit inflationary. So we're Pretty much in line. It is slightly higher, but generally we're managing it to the full year expectation.
Okay, perfect. And then a follow-up regarding the comment on pricing. Just, you mentioned tomatoes, among other things, in the grocery and snacks business. How would you characterize the positive pricing there in the quarter? Was that, due to anomalies in the base period, anomalies in the quarter itself, or are we looking at what appears to be a more durable, positive price mix for that division from here on new pricing or lingering pricing, which is now being fully reflected in the P&L? Thank you very much.
Yeah, I mean, we obviously got the biggest benefit was from the tomato pricing, and we saw the expected benefits there. The elasticities were good and in line with what we expected. We also did have a benefit of mix in the quarter. So our price mix, which was a little over 4% for the quarter, we did get a benefit of mix, which contributed as well. And so, a lot of our businesses in grocery and snacks are progressing as we expected, and so that's driving a good mix for us. So that was part of the equation as well in the quarter.
Okay. All right. Thank you.
Yep.
The next question comes from Alexia Howard with Bernstein. Please go ahead.
Good morning, everyone.
Good morning, Alexia.
Okay, so can I ask to begin with just about the productivity improvements in the food service channels? Seemed as though they were particularly strong this quarter. Is that likely to continue going forward?
It was definitely a strong margin performance for food service. There's been a little bit of weakness in traffic in food service, but I'd say overall it was a very good quarter. And I think that is just an example of the productivity and total cost savings performance we expect across the portfolio, Alexia. So food service has opportunities, but we've also got opportunities across the international business and the retail business in the U.S. as well. So we expect strong continued cost savings performance across the total portfolio. Yeah.
Great, thank you. And then can I just hone in on private label in the frozen vegetable area? There seems to be some confusion out here about whether private label is becoming more of a problem just broadly, or whether it's actually still fairly contained. Is there anything that you're seeing in terms of private label, either in frozen vegetables or more broadly, that would suggest it's becoming more of an issue? Or is it really that, the supply chain challenges have been overcome on the private label side, but there doesn't seem to be any major red flags or anything on the horizon?
Yeah, let me kind of frame that up for you. So you've got the big picture of how that works. Overall, as a company, we under-index, as I mentioned a few minutes ago, versus private label. That is obviously category specific. So there are some categories that have more private label. A good example is canned tomatoes, where you basically got Hunt's, you've got private label, and then you've got some kind of regional brands that are smaller in the area. One of the other categories where there is a larger piece of private label is frozen vegetables. But as you think about vegetables more broadly, vegetables are sold frozen, they're sold in the produce section, and they're sold in the canned food section in the center of the store. And there's been a lot of movement between that as value-seeking behaviors have been out there. And one of that has been actually about 6 months ago, some trade out of frozen into canned, and we're seeing that come back. Within frozen vegetables, Alexia, there's kind of the commodity vegetable tier, and then there's the more premium steamer, and then value-added tier, which is sauce, seasoned, things like that. For the last 2 years, we have been focused on building our business and our innovation pipeline on the premium value-added space, and actually pulling back on the commodity veg space, doing more value over volume, as you've heard us talk before. And the reason for that is because that's a lower margin business. Not surprisingly, it's more commodity oriented. So there's a role for us to play, or that business plays a role for us as a company in terms of overhead absorption in our vegetable plants. But our aspiration is not to be, the world leaders and fastest growers in commodity veg tier within frozen, because, that's just arguably a bit of a misuse of our resources that we could, people and otherwise, put elsewhere, because there's not much of a profit pool there. So it's important for us to maintain a certain scale of business there for overhead absorption purposes, but that is not strategically where we play. When we look at frozen vegetables, we are looking, and you can see in our innovation pipeline, and more premium products and more value-added tier.
Great. Thank you very much. I'll pass it on.
The next question comes from Rob Dickerson with Jefferies. Please go ahead.
Great. Thanks so much. John, just a question specific to frozen. It sounds like the ROIs, on the investments have been attractive. You seem very kind of upbeat and, encouraged to the momentum on the business. But at the same time, when we think about kind of what's happened in the quarter, it doesn't really seem like a lot of that was driven necessarily by kind of upside, so to speak, within that volume component within refrigerated and frozen. So I'm just curious, as you speak to those investments, are we talking, kind of more promotional activity, doing better and better pack and bigger pack sizes? Just trying to gauge, kind of what's like your perspective as to, why the ROIs are good and kind of what you're doing right. Because optically, as we look at the number in the segment, which does include refrigerated, it's not really better, and there was, I think, a little bit of an easier compare. So just trying to gauge, get a little bit more color on that one piece.
Yeah, I think to not get too twisted up in the optics of the combined R&F segment, if you look at, I think it was page 10 of our presentation today, which was consumption in our consumer domains, that's really the key kind of evidence point of what we're seeing from our investments. So our investments have been heavily skewed toward frozen, as I mentioned, because that's very strategic business for us. And that line, that consumption line there in terms of volume change has moved from -7.8 in Q1 of fiscal 24 to -2.8 in Q3 24. And in the first month of the fourth quarter, that number is about a -1.2. So that's when I reference the nearly 7-point swing in consumption that we've seen over the last couple of quarters. That's precisely what I'm talking about. And that is a very, very meaningful move in terms of the category. I think you'll be hard pressed to find a bigger move more broadly in food. What is creating the noise in the R&F segment data is the refrigerated, which I don't have here for you broken out, volumes, dollars in the absolute, which is a function of two things that I referenced. One is the rollback in prices because of the deflationary categories there, and also the wrap that we had in one of our table spreads business. So that's really what's behind that. But the movement in the volume is the basis for the ROI comment that I made, and you can see how that movement has come out. It's been very material and continued in Q1.
And then just a quick question on gross margin, very simplistically. Clearly, hear all your comments and prepared remarks around productivity, efficiency, got a little more pricing in grocery and snacks, all positive. But I'm just curious, like what changed relative to coming out of Q2, right, in early January? Because I think the commentary previously for the year was gross margin would probably be similar back half, maybe relative to Q2, but now it seems like it'll clearly be better in the back half relative to Q2, and that kind of took place over the course of 2 months. So seems like something changed to the upside. Just like to know what. That's all. Thanks.
Yeah, Rob. So I think you'd agree that if you'd look over the last 6 quarters, there's been a lot of volatility in our supply chain. And so, when forecasting gross margin, we want to make sure that we're considering, all scenarios around operations. The fact of the matter is that if you look a year ago, we still had a lot of things going on in supply chain with some recalls and some other challenges that we had that did impact the profitability. So as Sean talked about, our core productivity programs are on track. We're focused on the projects we're executing. So we're really seeing that benefit. The inflation's still coming in. we're still investing, and you see those as part of margin. And we still have a headwind from absorption. So because the volumes are down, and importantly, we're driving inventory down. So our production in our plants has been down, and we're managing that. That's been a headwind, but we haven't had any other disruptions like we've had the last couple of years in supply chain, given the environment. That now we're really encouraged that we're able to fund the investments we want to fund and execute our productivity programs and drive the gross margins that we're looking for. So one quarter doesn't make a year, but we're really encouraged by what we saw this quarter, and we're going to build on it.
All right, super. Thanks, Dave. Appreciate it.
Yep.
This concludes our question and answer session and concludes the conference call. Thank you for attending today's presentation. You may now disconnect.